All right, so we have done step acquisition, we have done disposal, and we are going to another one under consolidation. Under corporate reporting, the consolidation are in five branch. Should I say five branches? I don't know. But then in five forms, we have the step acquisition, we have the disposal, we have the complex groups, we have the cash flow, and we have the foreign subsidiary. So we are going to finish this week. We finish everything. So we do foreign subsidiary on Saturday, then we do cash flow on Sunday. Then we know that we are done. Tomorrow we are doing lazy. Tomorrow we do lazy. So Saturday we do additional one standard. Then Charlie, you can go and do whatever you want to do. Okay. So today we are going to look at what we call complex groups. You see, complex group is not anything. It's not anything. The consolidation, how to calculate goodwill and everything is the same thing. Okay, the net asset, everything is the same. But there are certain issues that you have to take into consideration. Okay, under basic consolidation, in financial reporting, one of the exceptions to preparation of what group accounts, we say that a company might have control over the other company, but there are certain situations that might not allow that particular company to prepare what a group account. And we say that one of them is when the parent itself is wholly or partially owned by another parent. So A is having control, is having 70% in B, but okay, A is having 70% of B, but C is having 70% or is having 70% of A. Also, you can see that A is a parent of B, but C is also a parent of what? Of A. So in this case, A cannot prepare what? A group account because A itself is a wholly or is a partially owned subsidiary of another company. That's one of the exceptions that we look at. We can also say that when the securities of the entity are not traded in the public domain, their securities are not publicly traded. We can also say that there is no need for you to prepare a group account because your account will not be published. So the shareholders can decide that you should not prepare a group account. So those are some of the exceptions when one of the subsidiary or one of the optimist subsidiary has already prepared a group account that has complied with all the necessary financial reporting standards. But our concern is not about that one. Our concern is going to be when the parent itself is a wholly owned or is a partially owned subsidiary of another company. The example is B is having control, B is having 70% in C, but A is having 80% in B. You can see that B owns C, but A owns B. So B cannot prepare a group account because B is owned by another company, which is A. So A will be allowed to prepare a group account to include both B and C. If this thing happens, this is what we call the complex groups, where one company is the parent of another company, and another company is the parent of the company that is the parent of the other company. So you can see that you are the owner, or you have 70% shares, or Vodafone is the majority shareholder of Tigo, but MTN is also a majority shareholder of Vodafone. So you can see that Vodafone is owned by MTN and Airtel Tigo is owned by Vodafone. So that is what we call the complex groups. So the complex groups, we have two types. We have what we call the vertical group structure. And we also have what we call the mixed group. Okay. The vertical group is a situation where A has 70% in B, and B also has 60% in C. So A owns B, but B owns C. So in this case, A is not having any percentage holding. A is not having any percentage holding in C. A is not having any percentage holding in C. A is the owner of B, but B is the owner of C. So if you say vertical, the A or the parent itself is having control over the subsidiary as a result of what the control that they have over the subsidiary itself. So what we say is that this is what we call the subsidiary itself, and this is what we call the subsidiary, the subsidiary. So the vertical group is a situation where the parent is having a control in another company as a result of what the control that they have in existing subsidiary. So A is the owner of B, B is the owner of C. A is not having any direct investment in what? In C. Yeah, Sinafalis. Oh.
Yes, sir. Sorry, the network was disturbing me.
Okay.
So I just came back and I beg if the group can allow you to just recap what you have started for me. I'm pleading.
Don't worry. The group has no influence. So if you just make your points clear, then we go according to what you have said.
Okay.
But if you are saying that you are pleading like it is going to put some kind of flex in us so that we want to flex on you small. You get it? So
Right.
just make it clear so that we go. So what we are doing is that we are doing what we call a complex group structure. A complex group structure, what we mean is that B is the owner of C, but A is the owner of B. So B has control over C, but A has control over what? Over B. So in this case, you can see that A is going to control both B and C because B owns C, but A owns B. So you can see that since A is the owner of B, it means that A will be the owner of C too because A are the owners of what? B, and B owns C. So indirectly, A is also the owner of what? Of B. Because if I'm the owner of the company and you also own another company, it means that indirectly I'm the owner of the other company. That's why we say the complex groups. So B owns C, but A owns B. So indirectly, A is the owner of C. That's why we say our network don't want to help, but don't worry, we will finish. Okay, so B owns C and A owns B. So we can see that the owner over here is also owned by another company, which is A. So indirectly, A is the owner of both B and C. That is what we call the complex groups. So you are the owner of your wife's company, and your wife also owns another company. Indirectly, you are the owner of your wife's company, in addition to the company that your wife is also having control over. That is what we call the complex groups. And the complex groups, we have two types. We have two types of the complex groups. We have what we call the vertical group structure, the vertical group structure, and you also have what we call the mixed group, the mixed group. So the vertical group is what I have said. A is the owner of B, which is 70%, and B also has 80% in C. So in this case, A owns B, but B owns C. Indirectly, A is the owner of both B and C. That is what we call the vertical group. This place, the vertical group, A is not going to have any direct investment in the sub-subsidiary. This is what the C will be called sub-subsidiary. Sub-subsidiary. So sub-subsidiary. And B is the main subsidiary. Okay, so B is the main subsidiary. Okay, let's come here. What do we do? Let's come to this place. Okay, you can see that A is having how many percentage holding in B? What's the percentage holding of A in B?
70.
Is 70%. And B is having how many percentage in C?
80.
Okay, can we say that indirectly A is having 70% of the 80% that B will be having C? B will be having in C. A is going to control 70% of what the 80% that what B is having in C. Because we have 70% over here. We have 70% in B. So if B is buying C, it means that we are going to have 70% control that we have over here. We are going to exert this 70% in the new company that we are buying. So A is going to be using 70% of the 80% that what B is having in C. So that is the indirect situation. A will be having an indirect control. Indirect control. Okay. Okay. You have given me 50 Ghana. You are giving me 50 Ghana. Okay. You are giving me 50 Ghana. And I haven't paid you the 50 Ghana. And I've also given 100 Ghana to someone. Okay. You have given me 50 Ghana. And I've also given 100 Ghana to someone. Can we say that you have 50 Ghana out of the 100 Ghana that I'm giving to the person out? Can you say that you are having 50 Ghana out of the 100 Ghana that I've given to that particular person?
Yes, senior.
Yeah. So that is the situation over here too. You have 70% holding there. I have 70% holding over you, and you have 80% holding. It means that I can influence the decision, every other decision that you are going to take regarding these people by my percentage. I have 70% holding in your company, and you also have 80% holding. It means that any decision that you are going to take regarding this one, I'm going to influence that decision by the 70% holding that I'm having over you. So what we do is that we try to find the indirect control that the parent company itself, which is the A, is having over the subsidiary. How do we do that? A will be having 70% of the 80% in C. So what we do is that we do 70% times 80%. What are we getting? We find what we call
56%.
56%. So this is what we call the indirect holding or the indirect control. So for you to find the indirect holding, the parent company will be having their percentage that they have in the subsidiary over the percentage holding that the subsidiary is having in the sub-subsidiary. Let's also look at this. So if the parent control now is 56%, it means that the NCI for the sub-subsidiary will be 44%. What we do is that we just subtract this one, the indirect holding, from the 100%. The indirect holding can be 20%. We still consolidate because these people is having control. We still consolidate. It's supposed not to be more than 50%. You can have the indirect control to be 36%. We still consolidate. So it's supposed not to be more than 15%. No. Okay, let's come here. A is having 70% here, which is B. Okay, and B is having 80%. Okay, we are saying that A will be having 70% of the 80% over here. Can we also say that the NCA will be having 30% of the 80% here? Can we say that the NCA In B, we'll also be having 30% of the 80% here.
Yes.
Okay. So what will be
No,
the
sir.
what will be the NCA? Okay. So NCA will also be having 30% times 80%. What are we having?
24%.
24%. Okay. What will be the NCA for C? What will be the NCA for C? That will be 20%, isn't it?
Sir,
Yeah. Yes, now Robert.
the NCI is not for outsiders. Yes, sir. NCI is not for outsiders.
No, the NCA is for the owners, but those are the portion that the parent is not buying. They are also owners of the company. So the shareholders.
They're also owners. Okay.
Yeah, the shareholders the number of shares that we have, we are able to buy only 70% of it. So the NCI is not
Okay.
NCA is not a liability. NCI is not a liability. NCA is just a portion of the shares that the parent.
Okay, thank you.
Yeah. The portion of the shareholders that are not selling their shares. Okay, so the 80% over here, the parent will have 70% of it, and NCI will have 30% of it. So it means that the NCI, the parent percentage holding in this one will be 56%. NCI will be 24%. But what is the NCI for? What will be the NCI portion in C? B is buying 80%. So what will be the NCI? What will be the NCI in C?
20%.
Okay. So you can see that the total NCI, the NCI percentage in C is 24. This is for NCI. And the new NCI will now be 20%. So the total NCI will now be 44%. And that is what I've done over here. That you subtract 56 from 100, you get 44 as the NCI in the what? In the sub-subsidiary. So what we do is that whenever there is a sub-subsidiary, we ask ourselves, okay, what will be the percentage holding? What will be the indirect? Because I'm the owner of your company, you're also the owner of another company. Indirectly, I'm controlling the two of you. So the question now is, okay, you are the main subsidiary and you have another company. You also have a subsidiary. What is my percentage holding in the other subsidiary? I have 70% control over you. You are having 80%. It means that I'm going to influence the other subsidiary with my 70%. So indirectly, what will be my percentage holding in the other company? It will be my percentage multiplied by the percentage that you have in the other company. That will give you the parent what? Shareholding. Now, if I'm having 70%, it means that NCI will also be having 30% of the 80%. So it means that the NCI in this particular company will be the NCI in the main subsidiary times the percentage that the main subsidiary is having over the sub-subsidiary. That will give you 24. And that is the NCI portion in the sub-subsidiary. And sub-subsidiary will also be having a different NCI. So you add this to the NCI, you have 44, which is also calculated as the what? The 100 minus what? 56. All right. How do we go about this? We have to consolidate the two companies together with the parents. So the first one, the main subsidiary, we consolidate it, calculate the goodwill and everything. But if you come to the sub-subsidiary, how do we go about the calculation of the goodwill? How do we go about it? How do we go about it? Okay, we are saying that the parent itself will be having 70% of the control in the sub-subsidiary, and NCI will be having 30% over the what? Over the sub-subsidiary. Will be having 30% of the percentage holding that the subsidiary is having in the sub-subsidiary. The meaning is that if the sub-subsidiary or the subsidiary has paid 200 million for the 80 million shares over here, or 80% shares over here, it means that the parent is going to take 70% of this, and the NCI is going to what? Take 30% of that. It means that the parent will take 70% of the shares that they have over there. It means that the assumption that the parent is paying what? 70% of this, and NCI is also paying 30% of this, because the parent together with the NCI, they are the owner of what? Of the subsidiary. So when they are buying additional subsidiary, it is seen that it is the parent and the NCI together who is buying what? The other subsidiary. So what we do is that whatever amount that the subsidiary is paying for the subsidiary will be shared among the NCI and the parent, because they are the owner of the subsidiary. So the 200 million that the subsidiary is paying for the shares of the subsidiary will be shared among the NCI and the parent. So what we do is that the parent will have 70% of this, NCI will have what? 30% of this. So if you want to calculate the goodwill over here, the goodwill for the subsidiary, our purchase consideration will always be the parent portion. The parent portion, which will be 0.70 times 200 million. Then we subtract the net asset from it. The 30% of this, the 30% of this one will be subtracted from what? The NCI of the main subsidiary will be subtracted from the NCI of the main subsidiary. So the 200 million is paid by the subsidiary B, but the subsidiary is owned by the parents and then the NCI. So the two of them will contribute and what? Purchase the shares of the subsidiary. This is the only thing that is about the group structure or the vertical group. So what we do is that the calculation of the goodwill of the subsidiary is different. Whatever amount that they are paying for the shares of the subsidiary, the parent will contribute its portion of the shareholding. NCI will also contribute. So we share it among them. The parent own will be the one that will be used to calculate the goodwill, and the NCI will also pay for their own. But since the NCI is not paying for their own, we subtract it from the value of the NCI. The question will always give you the indirect NCI, which is 44%. They'll always give you the fair value. If you are not given, they will ask you that you should assume that the NCI is calculated as a proportionate of the net assets, or the company is using a proportionate method. Okay. Let's look at a mixed group, then we move on. If you want to okay, now let's look at a mixed group. Okay, the mixed group, what happened is that A has 70% over here, B has 60% over here, but what will happen is that A itself is having 14% in C. So the vertical group, A has no direct holding in the subsidiary. But if you come to mixed group, which we also call the D shape, why do we call it a D shape? This is how it is going to be, D shape. So what will happen is that the parent itself is also going to be having a shareholding in what? In the subsidiary. So A has 70%, B has 60%, but A has what? 14% in C. A has 14% in C. So if you want to calculate the indirect holding, the A will be having 70% of the 60% here, which will be 70% times 60%. That will be the control that A is having over here. But already A is having 14%. So what we do is that we calculate the control, the percentage control that A will be having through the shares or the percentage that B is having over the C. Then plus what? The percentage holding that the A itself is having in the C. That is how we calculate the indirect holding. So this will be 70 times 60 plus 14. That will give us a direct holding. That is the only thing different about it. That is the only thing different about it. Okay. When do we start consolidation of the subsidiary? When do we start consolidation of the subsidiary? Okay. When A acquires B on January 1, 2011 or 2011, and B acquires C on June 2012, the consolidation of the C will start from the date that what the B has control over the C. Don't say that A has control over B on 1st January 2011, so you start consolidating what the C also from 1st January. No. C becomes part of the group on June 2012. So consolidation of the C will start from the date that what B has control over the what? Over the C. Will start from the date that B has control over the C. It can also happen that A acquires B on June 2012. Okay. B acquires C on June 2012. But B acquires, okay, A acquires B on June 2012, but B acquires C on January 2011. No, you can't say that B is having control over C on January 2011 before A acquires what? B. So consolidation of B will start from what? Will start from January 2011, or consolidation of C in the parent book will start from January. No, it will start from the time that what? The parent has control over the what? Over the main subsidiary, which will be June 2012. So consolidation starts from the date that what? The parent has control over the subsidiary. If the subsidiary has control over the sub-subsidiary before the acquisition, or the parent acquired the main subsidiary, consolidation will start from the date that what? The parent acquires the what? The main subsidiary. But if the parent acquires the main subsidiary before the main subsidiary acquired additional or a sub-subsidiary, consolidation of the sub-subsidiary will start from the date that the subsidiary acquires what? The sub-subsidiary. So you have to take note into that. The calculation of the net assets, everything is the same. Just this principle, how we can calculate the indirect method. The indirect method. If A is having 90% over here and B is having 60%, okay, it means that these 60% are being owned by the NCI and then the parents. What will be the parent portion of the 60%? The parent portion will be 90% of the 60%. That will be the parent portion in the C. What will be the NCI portion? It will be 10% of the 60%. That's what we call the indirect control, the indirect holding or indirect control. This is all about group structure. This is all about complex groups. And last two sittings were complex groups. Let's take question 1. Let's take question 1. Who is going to read for us? Question 1.
Okay. Good evening, question 1.
Hey,
Mini is a company.
Are you also in Ghana?
Senior Adeo.
Okay, it is well.
Thank you, Senior. Mini is a company which operates in the service sector. Mini has business. Sorry, a call came through. Oh my goodness. Mini has business relationship with BOA and Henry. All three entities are public limited companies. The draft statement of financial position of these entities are as follows. At 30th November 2012, so we have the assets and the liabilities there and the equity. Additional information. The following information is relevant to the presentation to the preparation of the group financial statement. On December 1, 2010, Mini acquired 70% of the equity interest of BOA. The purchase consideration comprised cash $730 million. At acquisition, the fair value of non-$5 million. Value of the identifiable net asset acquired was $85 million. And that of to on this one acquired of the of controlling interest was 72 million. A 30% holding was hold, and the 44% holding was $161 million. At the date of acquisition, the identifiable net asset of any had a fair value of $362 million. Retained earnings were $106 million, and other components of equity were $20 million. The excess in fair value is due to non-depreciable land. It is the group's policy to measure the controlling interest at value at the date. Both BOA and Henry were impairment tested at 30 November 2012. The recoverable amount of both cash generation needs, as stated in the individual financial statement at 30 November 2012, with BOA $1,425 million and Henry $604 million, respectively. The directors of Mini felt that any impairment was due to the poor performance of the intern and to think that others were already held at recoverable amount. Recoverable amount have been determined without consideration of liabilities, which all relate to the financing of operations. D. Mini acquired a 14% interest in Putin, a public limited company, on December 1, 2010 for a cash consideration of $18 million. The investment was accounted for in IFRS 9 financial instruments and deemed at fair value through other comprehensive income. On June 1, 2012, Mini acquired an additional 16% interest in Putin for a cash consideration of $20 million and achieved significant influence. The value of the original 14% investment on June 1, 2012 was $21 million. Putin made profit after tax of $20 million and $30 million for the years to 31st December 2011 and 30th November 2012, respectively. On 30th November 2012, Mini received a dividend from Putin of $2 million, which has been credited to other components of E. Mini purchased patent of $10 million to use in a project to develop new products on 1st December 2011. Mini has completed the investigative phase of the project, incurring an additional cost of $7 million and has determined that the product can be developed profitably. An effective and working prototype was created at the cost of in order to put that into a position for a further $3 million was spent. Finally, marketing costs of $2 million were incurred. All the above costs were included in the intangible asset. If Mini intend to dispose of a major line of parent business operations at date, the held for sale is the carrying amount for the asset and liability in the line of PP 49 million, inventory 18 million, current liability 3 million. It is at Mini will realize 30 million for the business. No adjustment have been made in the financial statement in relation to the above decision required. Prepare the consolidated statement of financial position for the Mini Group as at 30th November 2012.
Very interesting, isn't it? Very, very interesting. Augustine, how do you feel after reading the question?
It entails a lot, but you little by little digest it and get the understanding of it.
Will you get there?
It's interesting.
All right. So this one, who is the main who is the parent? Who is the parent here?
Meaning is the parent.
Okay. The parent will always be the first company. So they are asking us to prepare statement of what? Financial position. So I said that whenever you are asked this, you see some of the footnotes, you cannot adjust them. So just go and do your skeleton before you even move on. So we are doing this for mini group. So you put your mini group, then you come to consolidated statement of financial position. Financial position as at 30th November 2012. Is that okay? Okay. So how was the presentation done? We have asset first, isn't it? So we have our assets. So the assets, we have our currency sign here, which are all in million. Okay, it's not Ghana city, so let me just put it in dollar. Okay, so the first asset will be non-current assets. Is that correct? Okay, so under the non-current asset, what do we have?
You have PP.
Okay, we have PPE. That of the parent is what?
920.
Okay. Who is the main subsidiary?
BOA.
BOA is the main subsidiary. So we add the BOA figure to it. Then if we are going, then we see what will happen. Okay, BOA also acquired what? 80% of the equity shares of what? Henny. So it means that Henny will automatically be a subsidiary. So we can add that one to 310. Okay, let's come to the next one. Investment in what? Subsidiaries. You see that those investments will cancel their equity component. So we don't bring the investment. The investment will cancel the equity component, which is a net asset. And the difference will come as a goodwill. So we don't bring the investment. Okay. But the investment, there can also be an investment in associate. If you read well, if you go to D, they say that Mini acquired a 14% in Putin. So you can see we have investment in Putin there. That investment in Putin will be classified as investment in associates because Mini has acquired additional 16%. That is now giving them what? 30%, a significant influence. So we have investment in associates. We will do workings for that. Then we bring it. We also have what we call intangibles. Okay. We have the intangibles there. Intangibles. Okay. What are their values?
198.
198 plus
for parent. 30.
30 plus what?
Plus 35.
Plus 35.
35.
So automatically, goodwill might come. So we put goodwill there. Okay. Then you can now move on to your current assets. You can now move on to your current assets. Okay. Okay, you can see that the current asset, they have given us a whole figure, isn't it? So we don't have to add anything. So corporate reporting, the only thing that they are going to be testing is these advanced issues, complex groups. So everything will be the same, but they are not going to be testing on addition and subtraction. So we have current assets here, and that will be, we have 895.
895, 480,
480.
then 250.
That's 250. Then we come to our equity and liabilities. Equity and liabilities. Okay. So we start with the equity, which is the stated capital. We only bring the parent's portion, which is the share capital. So the parent will be 920. The subsidiaries own will be cancelled with the investment. So you can see that we are not bringing the investment. We are paying for the investment. So the investment will cancel the shares. Okay. Let's come to other component of equity of the parent. The other component, the equity items, is only the parent own that will come. Okay, other components of equity, we have retained earnings. We do workings for this one, so don't worry. Then we come to the NCI. Then we now come to non-current liabilities. Non-current liabilities. What are the figures?
495
495
plus 123
plus 123
93
plus 93. Then we come to current what? Liabilities.
liabilities.
Okay. Just is before you even start working, just identify who is the parent, who is the subsidiary. Then you start consolidating before you come to that. They will give you ticks for all these things. So 408 plus 128
128
plus, okay, plus 138.
138.
Okay. So we can now go to our workings. We can now go to our workings. So the workings, the one will always be the group structure. So the group structure, we are going to have mini having what? BOA, and BOA also having what? Henny. Mini is having how many percentage holding in BOA?
70%.
Okay. And BOA is having what percentage in Henny?
80%.
80%. So NCA over here will be what? 30%. Okay.
30%.
Okay. If we come here, what we do is that we find the indirect holding. So let's find the indirect holding. This one, the NCA will be 20%. But we find the indirect holding. How do we find the indirect holding or indirect interest? Okay. You can see that the parent is having 70% in BOA, and BOA is now what? Is now having 80% in what? In Henny. It means that this 80% will now be shared among the NCI and then the parents of what? Of the BOA, because they are the owners of BOA. So if they are buying Henny, it means that it is the owners of BOA that are buying the what? The Henny. These owners, 70% for Mini and 30% for the NCI. So what will be the parent portion of the 80%? That will be 0.7 times 0.8. What are we getting?
56.
56%.
0.56. Yeah.
Okay. So the NCI for Henny will be 0.3 times their portion plus the 0.2, which is the NCI over here. So the NCI will also be having 30% of this. 70 parents will be having 70%. So this will give us 0.24 plus 0.2, and that will give us 44%. Okay, so the NCA for Mini is 30, but if you come here, the indirect holding is 56, but the NCA for Henny is 44%. This can also be calculated by subtracting the 56% from 100. If the parent is having 50% of the holding in Henley, it means that the remaining portion will be what? For NCI. So we are just looking, the indirect holding, we are just looking for what will be the parent holding in the sub-subsidiary. The subsidiary is having 80% in the sub-subsidiary, and the parent is having 70% in that. It means that the parent will be having 70% of the 80% in the sub-subsidiary. That will be 0.7 times 0.8. Then this is the group structure. You can put the acquisition date there, reporting date, and a post-acquisition period. You can put it there. We don't have any problem. The two will be the net assets. We are going to do the net asset for them one by one. We do the net asset for BOA first. Okay, so we do at acquisition, then we do at reporting. So we have million. So the first thing is we started with the stated capital. We calculate the net asset from equity side. So what is the stated at the date of acquisition? What is the stated capital of the BOA? What is the stated capital of the BOA? The question will not give you that, but the assumption is that the stated capital at the beginning of the year is the same as the one at the end, because we want to maintain what? A constant control over the year. So the stated capital at reporting will always be the same as what? At acquisition, because there is no additional issue of shares. So if you go to BOA, their stated capital is 400, both at acquisition and at reporting. There is no additional issue of shares because we want the parent to maintain the 70%. So there will not be any additional issue of what? Of shares. But let's come to retained earnings. Let's come to retained earnings. What is the retained earnings at acquisition? Oh, this network. What is the retained earnings at acquisition?
$319.
319. Okay. Where can we find that?
Footnote A.
Okay. So that would be
on December 2010. The
okay.
fair value of the identifiable net asset of A35 retained earnings of BOA were 319 million.
Okay.
And that component of equity was 27 million.
Okay. Yeah. So what about reporting? What is the reporting retained earnings, BOA?
BOA in the statement of financial position,
okay.
442.
Okay. What is the other component of equity at acquisition?
The acquisition was 27.
Okay. Reporting is what?
37.
Okay, 37. Would there be anything that will come again? No. But the question is saying that the fair value of the identifiable net assets acquired was what? 835. But what is the net asset reported in their books? If you want to know what they reported in their books, is the figure that we have used. So this 400 plus 319 plus 27. What are we going to get? 400 plus
746.
It should be 746, isn't it?
Yes, sir.
What is the difference?
$89.
Okay, the question says that the 89 is due to what?
Fair value due non-depreciable land, excess in fair value due to non-depreciable land.
So this is as a result of a land that was not recognized. So the land, we are not depreciating it. So it means that the value at the beginning will be the same as the value at the end. But the question now is this particular land was not recognized. If the land should have been recognized in the statement of financial position, we should have gotten 835 straightforward from this preparation. It means that the only figure, the only net asset recognized in their books is 746. The 89 relating to the land was not recognized. So since we are putting it there, it means that their PP must increase by the land. They have to recognize the land now. They have to recognize the land now. Any issue about that before we move on? Okay.
Yes, sir. Please, sorry, the 89 you are
The 89.
my line went off.
Okay.
Yes, sir.
Yeah, the question is saying that the identifiable value of the net assets at acquisition is 835. But the question is, what is the value of the net asset recognized in their books? The value would have been the stated capital 400, 319, and other components of equity, which are all the equity items at acquisition. So you just add this 400 plus this plus this. What is the figure that you are getting? 8746. So this is the net asset in their books. But they are now saying that it is 835. What is the difference? The difference is 89. So it means that there is an item
Thank
of
you very much.
was not recognized. And they say that that is due to what?
Yeah, thank you.
To land. So we have to recognize that now. Okay. So can we total this?
Yes, sir.
Can we total the two now?
The acquisition is 835.
835. Okay, that will be 835. Reporting will be what?
Reporting is 968.
968. Okay. Can we find it? Okay, can we find the post-acquisition profit straightforward from that, please? So the
That's
post,
133.
okay. 133.
3.
Okay. 133 million. And this 133, what will be the parent share? So the parent share, oh, this network. Oh. The parent share will be what? 70% of this, isn't it? 0.7 times 133. NCA share will be 30%. So it will be 0.3 times 133 million. What are we getting for the parents?
$93.1.
93.1. NCA is what?
39.9.
39.9. You see, this one, mostly there will not be any, like,
Linus,
yes, please.
please, can you go back to the other page? I want to write something. Sorry.
Okay. Mostly they will not give you any post acquisition
Okay,
adjustment.
thank you.
There will not be plenty post acquisition adjustments like the way you used to do it in FR. No, there will not be realized profits, those plenty things, additional depreciation. No, the focus is not going to be about those things, but they can still bring them. But the focus will not always be about that one. What will happen is that since we are getting the information now, let's move on to NCI. Let's see whether we can move on to NCI. So let's look at the NCI.
Let me ask that.
Okay.
Linus.
Yeah.
Please, why are we not using the indirect for the 56 and the 44?
That one is for the subsidiary.
So that one is for the subsidiary.
Yeah, it is for Henny. For the main subsidiary itself, the parent will have 70% and the NCI will have 30%. But it is the subsidiary that will be 56 and 44.
Okay. All right. Thank you very much.
Okay.
Thank you.
So let's do the NCI. Since we have information about the NCI, let's put the NCI there and move on. So the NCI, the non-controlling interest. So we do this one for BOA. Okay. So the NCI at fair value. What is the fair value of the NCI at acquisition? That was 295, isn't it? Okay. And the NCA will have
Yes.
they will have the share of the post-acquisition profit, which is BOA, and that will be 39.9. I hope I'm correct with that. Okay. Okay. Let's calculate goodwill for BOA. Calculation of goodwill. Before we do the net asset for the subsidiary, let's calculate goodwill for these people. So calculation of goodwill. So calculation of goodwill, we have the purchase consideration. What is the purchase consideration? How much are they paying? How much are they paying?
730 million.
Okay. And the NCI, we add the NCI to it. You can decide to subtract the NCI from the net assets, but you can add, let's add it. So the NCI is 295. Okay, so what will be the total now? Then we take the net asset from it, which is 835.
$190.
Okay, the goodwill at acquisition will be 190. There might be impairment of goodwill, so we leave it like that. So if there's any impairment, we come and adjust it. So the next thing that we have to do is we have to calculate the net assets. We have to calculate the net asset of the subsidiary, which is Henny. So we do the net asset of Henny. The question will also give you information on the net asset of Henny. So we do at acquisition. We do at acquisition, and we also do at reporting. Okay, so the figure will be here, the figure will be here. We start with their stated capital. What is the stated capital for Henny? You will get it in the statement of financial position. That is how much?
200.
Okay, 200. What is their return earnings?
$106.
Okay, 106. At reporting is what?
139.
139. Do they have other component of equity at acquisition?
They had
Okay, other component of
20.
equity. That will be 20.
20.
At reporting is what?
25.
25. Take note of this. Okay. What is the increase in the other component of equity here? Would that be 10?
5.
That would be 10. So the parent will take each portion of the 10 to what? To other component of equity. So the 10 is included in this one. So, but the NCA will have all of them. The NCA will have the portion of the profit itself and then the other component of equity, which they will total it and put it there. So this 39.9, we don't have any issue with it. But if you are coming to share it for the parent, 123, 70% of the 123 will go to retain earnings and 70% of 10 will go to other component of equity. Take note of that. I nearly forget. Okay. Let's now come. What is the value of the identifiable net asset given to us? What is the value of the identifiable net asset given to us by on Henny?
362.
362. Okay. But what is the value of the net asset recognized in their books? What is the value?
326.
It is the same as the 326. Ah, okay.
No, this
362.
362.
Okay.
Yes.
What is causing the difference?
Fair value, non-depreciable land.
So what will be the difference?
36.
Okay, so 36 will come here. 36 will come here. So this 36 was not recognized. We go and add it to their PPE 36. Okay, let's now come. So this will be 362. And this will be what? The reporting will be what?
$400.
400.
Okay, what's the difference?
$38.
38. Okay, this 38 will be shared like this. The parents will be having 0.56% of the 38, and NCI will be having 0.44 times the 38. So this is where we show the indirect control and also this. Okay, the mini, okay, this can also be break like this. The 38 can be break like this. Okay, you can see that the 38, okay, the 38, this 38 will be shared among what? The 38 will be shared among BOA and the what? The non-controlling interest of those people. Let's look at this. You see the 38 will be shared by what? BOA, which is 80%. Okay, and NCL will be having what? 20%. Is that correct? The 38 profit of Henny will be shared. BOA will be having 80%, and the NCL will be having what? 20%. Is that correct? Are we correct with that assumption?
Yeah.
Okay. If we are correct with that assumption, then the 38, what will be a BOA share of the 38? What will be a BOA share of the 38? (0.8) times 38. I'm having 30.4, isn't it?
Yeah.
Okay. This 30.4 will be given to BOA, and BOA is owned by Mini and the NCI. So Mini will be having 80% of this. Mini will be having 70% of this rather. Mini is having 70%. This profit will be shared among the parent and the NCI, and the NCI will be having what? Will be having 30% of that. Let's now find Mini 70% of this. 70% of the 30.4. What are you going to get?
$21.28.
Okay, 21.28. Now, find 0.56 times the 38.
$21.28.
So you can see that the loan process that I have shown now, that the 38 will first be shared among the BOA and the non-controlling interest of what? Henny. Then that 70%, that 80%, which is 30.4, will now be given to BOA. BOA is now owned by what? Mini and the non-controlling interest. So Mini will now have 70% of the 30.4. So what we are doing is that instead of us to find 80% of the 38 before we find 70%, we first find the 80% of the 70% and now multiply the 38 by the weighted average figure. That's what we do. Let's now come here. 20% times 38. 20% times 38. What are we getting? That will be
7.6.
okay, 7.6. Okay, this 7.6 will be for the what? the non-controlling interest of what? Henny. But this 30.4, the NCA of BOA will also be having 30% over here. So let's find the 30% of the 30.4. That will be 9.12. So the total value of the NCA now will be the 20% plus the what? The 9.12. So if you add the two, you'll be getting 16.72. Find 0.44 times 38 and see something.
16.72.
Okay, so instead of us doing that long way, we decide to what? Find the weighted average before we multiply it on the what? On that particular figure. So we count to the non-controlling interest of meaning, we put the two together. So you can put all the non-controlling interest together. So the fair value, you can also put a fair value. This will be relating to Henny. Okay, the question has given us their fair value. So the question has given us their fair value, which is the fair value of the NCI is what? What will be the fair value of the NCI? The 44. It will always be the 44, indirect, the total NCI, not 30, 20, no. You use the 44. So the 44 is what? The NCA value.
161.
Okay, that will be 161. So the share of the post-acquisition profit. Put the two NCA together, put them together. Okay. Share of the POP relating to Henny will be 16.72. So the next thing that we have to do is to find the goodwill relating to Henny. Pay attention to how we calculate the goodwill. Okay, calculation of goodwill.
Hello, Linus.
Yes, senior.
Can you please go back to the previous page for me? Okay. Thank you.
Sorry, my head.
Sorry.
Okay, what we do is that we solve the additional, I'll try to solve the additional information of the question too, Charlie. My head. We only solve the additional information, not the question itself. My head is aching.
Drink water. It will be okay.
Okay, so let me take some 5 minutes and come. But don't think that the things are plenty in my head. That is what the things are not.
I know. You need to get a wife too. It will help you.
Even a girlfriend will do.
Maybe
No, wife.
Can I move on to the next page?
Yes, senior.
Okay, so this is how we do it. If you come to the calculation of goodwill, this is how we do it. So the calculation of goodwill, we use the purchase consideration. The goodwill will be recognized by only the parents. So the question now is, what is the consideration paid by BOA for the 80%? What is the-
320.
Okay, this 320, you see, this 320 was paid by the shareholders of what? Of BOA, isn't it? Okay.
Yes.
This 320, Mini is going to pay 70%, and NCI is going to pay what?
30%.
30%. So we are only calculating the goodwill for what? For the parents. So the BOA is paying 320, and BOA is being owned by the Mini and the non-controlling interest. So this 320, Mini will be paying 70% of it, and the NCI will be paying the remaining portion, which is 30%. So the only figure that we use over here will be the portion that Mini, the parent, will be paying out of the consideration. So that will be 0.7 times 320. What are you getting?
224.
224.
4.
Okay, 224. What we do is that the NCA will now pay the 30%. So the NCA will now pay. So the NCA, since the NCA are not paying, they are not giving money out, we now subtract it from the net asset that we have. So we look at the share of the consideration, the share of the purchase consideration. So that will be 0.3 times 320. That will give us how much?
96.
So the 96 will be subtracted. This will be paid out. So the parent is paying their own, but the NCA, they are not giving money out. So that will be taken from their value. So the portion, the consideration will be paid in the proportion of the shareholdings in the subsidiary. The 320 is paid by the shareholders of what? Of BOA. And these shareholders, the parent is having 70%, NCA is having 30%. So we only use the parent portion to calculate the goodwill, because the goodwill is going to be recognized by the parent. The question now is, what is the value of the NCI? The value, I hope we are given, and we have that value already, which is 161. Okay, 161. Okay, so if we add the two, what are we getting? 224 plus 161.
385.
385. So this 385, we subtract their net asset at acquisition from it. Net asset at acquisition is 362. 362. So what will be the goodwill at acquisition?
23.
23. So that is the goodwill at acquisition. We are done with that part. We are done with the first footnote and the second footnote. Let's now come to, they say that it is a policy, it is a group policy to measure the non-controlling interest at fair value at the date of acquisition. That is why they are giving you the fair value. That is what, so they are using a full goodwill method. Let's come to C now. Let's look at what is happening at C there. What is happening at the C there? C.
Both BOA and Henry were impairment tested at 30th November 2012. The recoverable amount of both cash generation units, as stated in the individual financial statement 30th November 2012, were BOA 1425 million and Henry 604 million, respectively. The directors of Mini felt that the impairment of asset was due to the poor performance of the intangible asset, and it was deemed that other assets were already held at recoverable amount. The recoverable amount had been determined without consideration of liabilities, which all relate to the financing of operations.
Okay, so they are just telling you about an impairment test conducted on the what? On both BOA and Henny. And they have given you the recoverable amount. And the question says that if there's any impairment, it will be due to only the intangible assets. Only the intangible assets. And the question is also saying that the recoverable amounts are being what? Determined without taking into consideration the liabilities. Okay. Whenever we are going to calculate the recoverable amount, we calculate it for only the assets, because the liabilities will be transferred. The liability will be transferred. So the recoverable amount should be calculated for the net asset. But this one, they are calculating it from the total asset. They are calculating it for the total asset. They are calculating it for the total asset. So what we do is that we count to the what? To the financial statement of these two companies. The recoverable amount was determined at the reporting date. It is determined at the reporting date. That was determined at the reporting date. Okay. Since that was determined at the reporting date, we count to the statement of financial position of the company and pick their net assets together with what? With the liabilities. So let's take their total assets. For BOA, what's the total asset for BOA? So we carry out the impairment on them one by one. So let's do it for BOA first. So we have workings 5. Let's do for BOA, the impairment of BOA. Okay. So what is the net asset as per the assets? Assets, not net assets, total assets. Let's talk about total assets. That will be total assets.
1130.
Okay. So the asset that is given. So this one, we don't use net asset because the question says that the recoverable amount was determined without taking into consideration the liability. It means that the liability is included as part of what? The recoverable amount. So we take it from the total side. So the total assets per the statement of financial position is 1130. Okay. But you can see that there was land. The land was not recognized in the statement of financial position. What is the value of the land for BOA? It was 89.
89.
So we add the 89 to it. Those assets that were not recognized will be added. Then we come. You can see that they are now having a goodwill. The goodwill is also relating to the BOA. So we take that also into consideration. What is the value of the goodwill? 190. Okay. So goodwill will now be 190. So what is the total value of BOA now? What will be the total value? The value as per statement of financial position, land was not taken into consideration, but they have a land which was not recognized. So we add it. Goodwill is not also recognized over here. We add a goodwill to these figures over here. What will be the assets? What will be the total assets at reporting for them?
1409.
1,004. 1,000 for what?
1409.
1409.
1409. But what is the recoverable amount? This is the carrying value. What is the recoverable amount given in the question?
1425.
25.
Recoverable amount is 1,425. Is there any impairment? Is there any impairment? Is there any impairment relating to that?
Yes.
Yes.
Are you sure?
Oh,
When do we see there is an impairment? When the carrying value is higher than the recoverable amount, isn't it?
yes.
Yes.
But you can see that the recoverable
There's no
amount,
impairment.
yeah, there is no impairment. So we move on to that of Henning. So we count with Henning. So the Henning to use the same thing. The total assets recognized by as per the statement of financial position. So their asset is what? Is
595.
595. Okay. So this 595, they also have land. The question says that the difference was due to something, and their land value is what? 36. So the land will be 36, and we also have goodwill relating to them. The goodwill will come. What is the value of their goodwill? That was 20.
23.
23.
Okay. So what is the total value of their
Yes, I can see the board, or is I'm alone.
654.
maybe you are alone?
65.
Okay, because some people can see and I can see myself. That will be 654. I hope all of you can see my board. Apart from the
Yes.
person who is saying that you cannot see. So you are alone. Okay. But in the other one, you will not be alone. People will be there with you. Okay. So this is the carrying value. But what is the recoverable amount given to us?
60.
604.
The recoverable amount is 604. Okay. So what will be the impairment now?
50.
Okay, the impairment will be what? 50. So that the question says that the impairment is due to what? Is due to what? Intangibles, isn't it? Okay.
Yeah, poor performance. Yeah.
Okay. So the intangibles, goodwill will be part. This is a car generating unit. So goodwill will take all the first impairment. So the goodwill for the Henny, we write all of them up. Because if it is a car generating unit, the impairment will now be 23. So goodwill will take all the what? The 23, and goodwill will now be 0. The remaining will be what? 27. Is that correct?
Yeah.
And that 27 will be taken from the net, from the intangible. So because they say that it is relating to the intangible, goodwill is part of the intangibles. So goodwill will take 23. Goodwill will take 23. Goodwill will take 23, and the remaining intangibles will take what? The 27. But impairment loss is an expense. So this expense of 50 will be shared among the NCI and the parents. So let's take the impairment loss. Let's share it to NCI. So NCI share of the impairment loss. So NCI share. The impairment is relating to Henny, isn't it? It's relating to Henny. So what will be the NCI portion of that? What percentage are we going to use? It's relating to Henny. So what percentage are we going to use?
We'll use the 56 and the 44.
Yes. So this will be 0.44 times 50. That will be for the NCI. So what will be the NCI portion of the impairment? 0.44 times 50. I'm getting 22. Okay. Can we do group return earnings? Can we show group return earnings? Can we show group return earnings? Can we show group return earnings? So the group return earnings will always start with the parent what? Return earnings. What is the parent return earnings there? The parent return earnings in the question is what?
895.
895.
So we have the share of what? Post-acquisition profits. So let's come here. The post-acquisition profit, we show only the portion that the parent will be taking. Let's come here. You can see the post-acquisition profit over here is 133, isn't it? Okay.
Yes.
133, out of the 133, you can see the other component of equity 10 is part, isn't it?
Yes.
Okay, so the other component, which is the 10, will go to other component of equity. The parent share of the 10 will go to other component of equity. So we only share 123, which is what? The actual profit for the year. The other component of equity can be including revaluation surplus, any fair value gain on financial instrument carried through other comprehensive income. So if the company or the parent is having other component of equity, we determine their portion of the share of the other component of equity and send it to other component of equity. So return earnings, we show only profit there. We take the share of the profit to that place. We take only the share of the profit. So the share or the profit for the year will be 133 minus the other component of equity, which is for the year, which is 10. So the share of the profits of BOA's profits will be 0.7 times 123. Then we come to that of Henny. It will be 0.56 times the profit for the year. And how do we determine that profit? How do we determine that profit? Okay, let's come here. You can see that the movement in the other component of equity is what? 5. Can we see that? The movement in other component of equity is 5. Can we see that?
Yes.
Yes.
And the post-acquisition profit is what? The
38.
post-acquisition reserve, let me put it post-acquisition reserve, is 38. So it means that the profit made for the year was only what? 33. 33. And the other component of equity, which is 5 added, that is why we have the 38. So we now come here and do 0.56 times 33. So what will be the total share of their profit in the two entities? 0.7 times 123. What are we getting? What are we getting?
Okay.
104.58.
Okay. 104.58. Okay. Let's now come here. What will be the share of the impairment? We can see that we have share of there was an impairment there. So their share will be 0.56 times 50. What are we going to have? There was an impairment loss there. What will be the value of the impairment?
28. No, wait.
Yeah, it's 28. And that is an expense. It's a loss. So 28. Okay, we are done with the C, and also we are done with A, B, C. Okay, let's now go to D. Okay, let me show the other component of equity as well. So 7, other component of equity. Okay, so the other component of equity, we are doing it for only the parents. So what is the parent other component of equity?
$73.
73. So we bring their share of the other components of equity for the year. That will be 0.7 times 10 plus 0.56 times 5. Do we agree with that? You can see that the movement is 10 for BOA and 5 for what? Henny. So let's put the two together.
So you consider the movements only.
Is that? Nick, I didn't hear you.
I'm saying now you consider the movements only.
Yeah, we consider the movement. The movement is the one. What is the difference between the one at reporting and at acquisition? So what is the difference? At acquisition was
Okay.
27 and was 37 for BOA. So the difference, the other component of equity made after acquisition is 10. And if you count to Henny, it was 20 and 25. The movement is also 5. So we look at any increase is after acquisition. So they have the share of those things happening after acquisition. So what are we getting there?
9.8.
9.8.
Okay, 9.8. Okay, I'm sure with this one, we are now okay. Can we send our goodwill? You can see that the goodwill that we are going to send will be only one, and that will be that of what? Only BOA, because Henny, all the goodwill has impaired.
Was impaired.
Okay, so we show that for BOA, and the goodwill will be, is it 190? Okay, I'm sure
Yes,
it's
190.
190. So we show only the 190. Okay. Let's now move on to D. Mini acquired 14% interest in Putin. So you can see that the 14% is is lower than 20% and also 50%. So this will be classified as a financial asset. You can only classify it as an investment in associate if it is 20 or more percent. That is the only time you can have a significant influence. So this will be classified as a financial asset. On December 2010, for a cash consideration of 18 million, the investment was accounted for under IFRS 9 financial instrument and was designated as asset fair value through other comprehensive income. So this is also part of the other component of equity. Any gain that is going to occur on the instrument will be sent to other comprehensive income or other component of equity. Okay. On 1st January 2012, Mini acquired an additional 16% interest in putting for a cash consideration of what? 27 million, and achieved a significant influence. The fair value of the original investment on 1st January 2012 was 21 million, and Putin made profit after tax of 20 million and 30 million for the years to 30 November 2011 and 30th November 2012, respectively. On 30th November 2012, Mini received a dividend from Putin of 2 million, which has been credited to other components of equity. Let's go to the statement of financial position. What is the investment in Putin there? What is the investment?
48.
48. Okay. Let's now come how they determine the 48. You can see that they have acquired additional 16% for 27 million, isn't it? Can you see that the additional 16% was acquired for 27 million?
Yes.
Okay. And the fair value of the original 14% is now 21 million, isn't it?
Yeah.
So if you add the two, what are you going to get?
48.
It means that they have already recognized a 3 million gain. You can see that there will be a 3 million gain on the remeasurement, which will be 18 against 21. The 14% was purchased for 18 million. Now they are saying that the fair value is 21 million. Is that the case? If the 21 million was not recognized, there will be a gain of what? 3 million. But since we are having 48 over there, it means that they have already recognized the 21 million plus the 27 million. That will give us a 48 million. So the gain of 3 million on the remeasurement has already been taken into consideration. Okay. At the time that you are buying the additional shares, the assumption is that you have sold the old shares and you repurchase them together with a new one. So we assume that you have sold the old shares, which is what? 80 million for 21 million, and you have recognized a gain of 3 million. And this gain has gone to what? Other component of equity. But we have sold the initial investment, so we are going to make a gain. The gain should be sent to retained earnings, not other component of equity. So what we do is that we transfer from other components of equity, the 3 million gain. So transfer of gain, which is 3 million. We transfer from that place towards retained earnings. So transfer from other component of equity. So that 3 million, which was a gain, has already been taken into consideration. That was how come they have a 48 million there. It means that they have added the 21 to the 27. But this gain is in the other component of equity. So what we do is that we transfer it from the other component of equity to what? Retained earnings. That is the only adjustment you do concerning that. Let's come to the second side. When was the additional shares acquired? Or when was significant influence achieved by Mini over the
Hello.
person? Yes, sir.
The 48 is sitting at the top there.
Yeah, the 48
Right.
is an investment. It's classified as an investment.
And so I thought we would take the 3 from the 48 rather.
No. At the time that control is achieved, we are now going to sell the 14%, which is 18 million. So we
Okay.
sell it and rebuy it at 21 million. So it will always be valued at the fair value plus additional.
But then, how do you know it's sitting at OCE?
Because the investment is classified through other comprehensive income.
Okay.
So you can see that it's classified through
Yeah,
other
the question
comprehensive
stated.
income. Yeah.
Okay.
So any gain that is on that, the assumption is that it has been taken to the other component of equity. Okay.
Okay.
The only thing is you can leave it, you can just leave it like that. Because at the end of the day, they all have the same effect. They are all gain. So no problem. All right. But the question now is, when was significant influence achieved? On what date? On what date do we have our shares more than
1st June.
1st June? Okay. 1st June. What is the reporting date now?
So
What is the reporting date now?
November.
Okay.
November.
So how many months is that?
Yeah, 6 months.
Okay. 6 months. So it means that the time that we are going to have an associate, we have those people as an associate for only what? 6 months, isn't it?
Yes.
So we are going to have a share of only their 6-month profits. So we come to investment in associate. We use the equity accounting method. What is the fair value at the time that we have the investment? We classify them as investment in associate. It is 48 million, which is 21 plus 27. So what we do is that we have a share of what? Associate profits. Okay. The share of the associate profits. What was the profit made for this year? You can see that they have given you two profit there. One is for November 2011.
30 million.
Okay, 30 million. But that 30 million, we are going to have only 6 months worth share of it because we have them as an associate for only 6 months. For only 6 months, June to November. So that will be 6/12 times what? 30 million times
30, yeah.
our shareholding. What is our shareholding? 0.3.
0.53.
Okay, that will be 0.3. So what will be our
14
share?
plus 60.
What will be our share there? 0.3 times 0.5 times 30 times 0.5.
But the so this 6 months, is it December to May or
No.
June to November?
It's from June to November, the time that we have them as an associate. So it will be from June to November, that is 6 months.
Associate, okay.
Yeah. So that will be June to December. June to November rather, which is 6 months. Okay. So from December to May, what was happening is that we just classify the instrument as what? Financial instruments. Anytime we just fair value it. If there's any gain, we send it to what? Other comprehensive income. That's what we are doing. But from 1st June, we now have a significant influence over them. So we have to classify the investment as an investment in associate. So the equity accounting method for the investment in associate will start from the date that the company has a significant influence over Putin. That is from June. From June to the reporting period, how many years or how many months is that? It's 6 months. So any profit that they made for that year, we are going to have only 6 months worth share of what? Of that particular profit. Nick, I hope this thing is clear now.
Yes.
Okay. So that will give us how much?
4.5.
4.5. Okay. That will be the share of the associate profit. But let's move on. Many received a dividend from Putin of 2 million, which has been credited to other components of what? Equity. Dividend is paid out of what?
Out of earnings.
Out of earnings. So you can see that this particular earnings that we are sharing over here is before dividend, isn't it?
Yes.
So it means that the dividend portion is part of this. Okay, the dividend portion is part of this. So the total investment that we are going to have will be 48 plus 4.5. But what will happen is that we receive what? A dividend from them. They have paid amount to us in cash. So in actual sense, the total earnings that we'll be receiving for the year is 4.5. So if we are receiving a dividend of 2 million, it means that we are going to receive a profit of 2.5. So that if we add the two, we now have what? The 4.5.
4.5.
So it means that the dividend is part of this one. So we come and subtract over here. So the dividend payment will be subtracted from the investment. It's just like you have put money in the bank, which is 48 million. At the end of the year, the bank has paid you interest of 4.5. But you went to the bank to withdraw some money. The withdrawing some money is the dividend. The dividend will be paid to you in cash. It means that they are giving part of the money that you have over there to you. So they are giving cash to you. It means that the investment that you'll be having over there will be reducing by the cash that you went there to withdraw. And that is how we account for the investment in associate. So the 48 was the money that you have in the bank, and the money has generated an interest of 4.5. But then again, you went to the bank to withdraw 2 million. It means that the investment that you'll be having over there will reduce by what? 2 million. So this is what we call the investment in associate. What will be the figure here? It will be 50.5. Am I correct?
Yes.
Okay. So that 50.5. So the 50.5 will come as an investment in associates, which is 50.5. Okay. Let me come to this place. The dividend was sent to where? Where was the dividend sent to? Where was the dividend sent to? The question says the dividend was
Other
sent to.
component of equity.
But must the dividend go there?
No, retain earnings.
Retain earnings. So what we do is that go and transfer it over here. The dividends will be transferred from this place, which is 2, to retain earnings. So we are now going to have a dividend of 2. Then we have the profit, share of associate profit. Share of associate profit will be 4.5 minus 2, because we have already recognized the dividends already. So the total profit should be 4.5. That will be the dividend plus the 2.5. But if you recognize 4.5, it means that you are receiving a total share of what? 6.5. But in actual sense, it should be 4.5. Dividend is paid out of what? Profit. So it means that the 2 million, which is the dividend, is part of your profit. So if the profit for the year is 4.5, you have received a dividend of 2. It means that the profit that will be left for you will be 2.5. So the profit that you are receiving actually is 2.5. So the dividend is part of the 4.5, because we are sharing profit before dividends, and dividend is paid out of what? Profit, or dividend is declared out of profit. So if you want to show the share of associate profit, it will be, if you are showing the dividends as a line item, then you show the remainder, which will be the 4.5 minus the dividend, which is 2.5. So if you add the two, dividend is paid out of profit plus the profit, the share of the profit itself, you are going to have 4.5. Okay, we are done with that side. Let's move on to the E. Okay, you see those who joined the intangible, the IS38 the last time. We can see that I've screenshot a page of the note which I didn't talk about, and this particular screenshot is talking about this E. If someone should take time and read that particular thing, it's talking about this E.
Maybe purchased patents of 10 million to use in a project to develop new products on 1st December 2011. Mini has completed the investigative phase of the project, incurring an additional cost of 7 million, and has determined that the product can be developed profitably. An effective and working prototype was created at a cost of 4 million, and in order to put the product into a condition for sale, a further 3 million was spent. Finally, marketing costs of 2 million were incurred. All of the above costs are included in the intangible assets of Mimi.
Okay. So let me read what I have sent to the page. In-process research and development. An intangible asset in the process of being developed by an acquiree entity may not be recognized in the acquiree's financial statement as internally generated what? Intangibles as prohibited by IS 38. However, an acquirer entity acquiring the acquiree must recognize such in-process intangible at fair value, which may be the cost in the consolidated financial statement. Post-acquisition research by the acquiree on the intangible is not capitalized but expensed as the asset is still internally generated by the acquiree and recognition criteria of in. So what they are saying is that, you see, we are saying that any asset, that is any intangible that is generated internally, if you can be able to differentiate the cost, if you can be able to differentiate the cost of developing that particular intangible from your normal operations, you should recognize it. But if you cannot, it should be expensed. And we also said that research and development, all research expenses must be what? Expensed by the person. But here is the case, the parent has acquired what? The project in its research stage. The parent is paying for it. So since the parent is paying for it, the parent will recognize that as an intangible. Even if the project is in the research stage, since the parent is acquiring it, the parent will recognize the initial amount paid as an intangible. Okay. Since the project as an intangible, the amount that they have paid for it to acquire the product or the project in its research stage, they will recognize it as what? As an intangible, because they can differentiate the cost from their normal activities. They are not carrying the project, themselves, or they are not carrying the research themselves. They are buying it from someone. So they are buying an intangible from someone. So they recognize the initial cost as an intangible. But if the project is still in the research stage, the parent will now carry out the further research. So the further research that the parent will be carrying out, any cost that will come out of that will now be what? An expense. Will now be an expense. So any cost after buying it, and you are now going to undertake or you're now going to continue the research yourself, any cost that you are going to get for a further research will now be expense because you are now carrying the research out. So you are going to expense that. Okay. Prototype. What do we call a prototype? Prototype is a sample of the product. So you can only develop a prototype when the product is ready. It's just a sample given to the customer. Maybe you have developed the product and you have now given the sample to the customers and see whether they are going to like it or not. If you are developing a prototype, we assume that the project is likely to be successful. So prototype, product design, and all those costs that will be incurred relating to the product, or all those costs that will be incurred for the product to be ready for sale will be what? Will be capitalized. So if you come here, Mani purchased a patent of 10 million to use in a project to develop new product on 1st December 2011. That is at the beginning of the year. Mani has completed the investigative phase of the project, incurring additional cost of 7 million. That is, they have undertaken what? Additional research on the project. This 7 million should be expensed because it's a research for the company. But the 10 million will be capitalized because they have paid for the patent. They have paid for the patent. So the patent will be recognized as what? As a purchase, what? Intangible. So the 10 million should be recognized as an intangible, correct. But the 7 million is a research cost. It's a research cost because they have completed the investigative. The investigative is the research part. So that should be expensed, but not capitalized. But they have put it in the intangible. So we are going to expense it. We are going to expense it. So we put all the costs together, put it in, we put all of them together. Then we put them as subtracted from the retained earnings and go and take it from their what? Their intangibles. Okay. Let's come here. Okay. An effective and working prototype was created at a cost of 4 million. So the prototype is just a product sample, product design. which will be given to the customers. Okay, so prototype, you are just designing the product. You are just designing the product. So it's also one of the things that will bring the product to a state that you can sell it. So prototype, product design, all those costs relating to the product will be capitalized. But the cost that you are going to incur after the product has been designed, like marketing costs, advertising costs, no, you can still sell the product without advertising it. It is not necessary for you to go to market or to go to radio stations or to go to TV stations and create awareness of your product. You can start selling to people that are around you without advertising anything. So marketing costs and those costs are not costs that you have to incur to bring the product to the stage or to a condition that it will be ready for sale. No. So if you come here, prototype will be what? Will be capitalized. So that is right. 4 million is right. A further 3 million was spent. Okay. And in order to put the product into a condition for sale, a further 3 million was what? Spent. So this 3 million can be like you went to see the government people because FDA have to approve the product. So maybe that licensing, that registration cost, if you don't pay it, you can't put the product up for sale. So that might be a cost of FDA or the EPA approving the product. So it's a cost that you have to incur to bring the product to a condition that will be what? Ready for sale. So that 3 million should also be what? Should also be capitalized. That 3 million should also be capitalized. Then let's come now. Marketing costs of 2 million were incurred. Should the marketing cost be capitalized?
No.
No. So 7 million plus 2 million will be expensed. So the 7 million, which is the research, plus the marketing, which will be 9 million. So we count to intangibles. So intangibles, the expense will be 9 million. Then we go to the intangibles and take what? The 9 million from it, because they are saying that all these things were what? Capitalized. So we take the 9 million from it. We take the 9 million from that. We take the 9 million from that. That is about that. And that was what I sent to the page the last time.
Yeah.
It's very important.
No, it makes sense when it's put in perspective like this. Because me, I just read English and went to my room.
Okay. It's very important. Intangibles is very tricky. Intangibles as a standard is very tricky. You have to be very careful. All right. Let's come to F. Let's come to F. And you have to know that IC is now changing what? The standard of the questions. Every question that you are going to see now, 90% of them will be about standards. It was those days that the console, you not see standards there. But the console now is full of standards. Capital reorganization is now full of standards. Business valuation is now full of standards. And the standard itself is there. Even they are making the regulatory framework, the ethical questions now to be standards. They will bring the question on standards and ask you how the person should go about it. So they are not changing everything to the standard. So if you don't have broad knowledge about the standard, it will over you. Okay. Let's come to the F. The F. Let's come to the F.
Meaning intends to dispose the major line of the parent's business operations. At the date the held for sale criteria were met, the current amount of the assets and liabilities comprising the line of business were PPE 49, inventory 18, current liabilities 3. It is anticipated that many will realize 30 million for the business. No adjustments have been made in the financial statements in relation to the above decision.
Okay. What standard are they trying to talk about here?
Is this more or less a cash generating unit?
IFRS 5.
Yeah, this is non-current asset for solar and discontinued operation, and this is cash generating unit. So this is a disposable group.
Okay.
So this is if it should be impairment, then it should be cash generating unit. But since it is held for sale, it is disposable group.
Again, you say if it's impairment,
If it is impairment, it will be a car generating unit.
okay.
But if it is helpful, so it is a car generating unit, but we call it a disposable group. All right. So let's come here. What is the carrying value of the disposable group? What will be the carrying value? What will be the carrying value?
70.
70.
It's not going to be more than 70. The liability will be net from the asset. So it will be 49 plus 18 minus 3.
3.
That will be
67.
64. Could that be 64?
67.
54.
Now we need the liability against that. So it will be
Yes.
64. Okay.
Okay.
So let's find the carrying value of the disposable group. Okay. So the meaning is that what we do is that the meaning is that we are going to use, after selling the assets, we use the assets proceeds to settle the liability. So if the asset is now 67, liability is 3. So it means that after settling the liability, we are going to have only 64. That is the meaning. So the carrying value will be PPE, which will be 49. So whenever you are determining what the carrying value of the disposable group, it should be net of what? Liability, unless the question says that the liability was not taken into consideration before determining what the recoverable amount, like the first one that we did. But since they have given the recoverable amount over here without saying anything, it means that they have taken the liability into consideration, and that is relating to owning the asset. Okay, so that will be 49. Then we have inventory. Inventory will be 18. Then we have current liabilities of,
Why is inventory in bracket?
sorry. Okay, so inventory will be 18. Liabilities will be what? 3.
3.
So the total will be 64.
64.
Okay. So what is the recoverable amount now?
30.
30.
Okay. So what will be the impairment?
34.
Okay.
34.
The impairment will now be 34. Okay. So this 34, how do you go about it? You can see that this is relating to only the parent. It is the parent that want to sell this. So the parent will be the one to suffer all the impairment, isn't it? All right. So what we do now is we are going to charge, yeah, Ms. Jackson.
Sir,
Yes, please.
forgive me, I don't know how you got the 30 and then the 34. Can you take it again?
It is, can you see the footnote?
Yes, I can see the footnote.
Okay, it is anticipated that many will realize what 30 million for the business. So that is the recoverable amount.
Okay. Thank you.
So if you compare that with the carrying value, that will be what? Okay, no adjustment have been made in the financial statement in relation to the above what decision. So our impairment will now be 30 million. Let's charge that first. Now let's now come to PPE. What is the value of the PPE that we are selling?
$49.
Okay, 49. Okay. And the inventory is what?
18.
18. Okay. Liability is what?
3.
3. So what we do now is that since no adjustments have been made into this, we are going to take the 49 from the PPE. We take the 49 from the PPE. The sharing of impairment is not important here. We are not doing a standard on each one. So we come and take inventory from this place, which is 18, because the inventory is included in what? In the current
Yeah.
assets. If you count to liabilities, we take the 3 out, okay? Then we come to PP, we take what out?
49.
49. Okay. What we now come and do is that we count to current as under the current items. Then we now have head for sale as a single item. And this head for sale will be classified at 30, the lower of the carrying value and the net realizable value. That is how the first classification will be done. It will be, we have learned that IFRS 5, the classification will be the lower of the carrying value or the what? The net realizable value. And the net realizable value is 30 million. So the carrying value is 64 million. That was an impairment of what? 34. So we pick the lower one. The classification will be done at lower of the net realizable value or the carrying value. So if the carrying value should have been 30, then we just classify the asset at 30. But since the carrying value is higher, it means that the asset has impaired. And we have charged the impairment of what? The 34 to this one already. So this will be 34 rather. This will be 34, not 30. Okay. So what we do is that this one is simple. You can see that we have reduced our asset by what? We have reduced our asset by 37. Can we see that? The asset has been reduced by what? 37. Because the inventory and then the 49 is 67. But we are now having 30 as head for sale. So it means that we have reduced our asset by 37. We have also reduced our equity side by 37. Return earnings 34 and liabilities 3. So we don't have any issue with that. And that is all about this question. Let's put the figures together and move on. So head for sale is 30. This will be 920. Let's come to the NCI, the total of the NCI. Okay, the total of the NCI will give us what? Let's add that. 295 plus 39.9 plus 161 plus 67.72 minus 96 minus 22. I'm getting 394.62. Can someone confirm that? Can someone confirm that for us? 394.62. Confirm? Oh, okay. Our calculators are not working. Okay. Let's come to, okay, we are okay with this side already. Let's come to our retained earnings. Let's confirm that. So 895 plus 104.58 plus 3 plus 2 plus 2.5 minus 28 minus 9 minus 34. I'm getting 936.08.
Confirmed.
Okay. Other components of equity. Can we confirm that 73 plus 9.8 minus 5? 77.8. Confirm?
Confirmed.
Okay. Investment in associates, we have done that already. So let's pick these figures. Other component of equity is 77.8. This is 936.08. Then we have 394.62. Okay. So this is 394.62. Retained earnings is 936.08. Other component of equity is 77.8. So 920. Can we put our liabilities together? 195 plus 123 plus 93. I'm having 711 here. Confirm.
Confirmed.
Your ability to point the calculator fast is also part of the exam. Okay. If you are not sure of the figures, just leave them and go. The ones that you can add it and go. Okay. 671.
Confirmed.
Okay. Let's add them. What will be the total? 671 plus 711 plus 394.62 plus 936.08 plus 77.8 plus 920. 3710.5. Okay. So let's count to the current asset 895 plus 480 plus 250 minus 18. I'm getting 1607. Confirm. Okay. Let's count to intangibles. 198 plus 30 plus 35 minus 27 minus 9. I'm getting 227. Okay. 920 plus 300 plus 310 plus 89 plus 920 plus 310 plus 300 plus 89 plus 36 minus 49. I'm getting 1606. So plus 50.5 plus 227 plus 190. So this is 2073.5. Let's put this one to it. Plus 30 plus 16 plus 1607. All right. That's all. Okay. So what we'll do is that we will try to solve the footnote of the question too. Okay. Yeah, Senior.
Senior,
Yeah.
the current assets, is it 895 or 815?
895.
Okay. Thank you.
All right, you're welcome. But your voice is down. It seems like you're not on top of issues.
Hello.
Yeah, your voice is down. It seems like you're not on top of issues.
It's
There's,
true, but
there's
it shall be
plenty
well.
issues. There's plenty issues. How can we be on top?
It is well.
I'm actually not on top, but it shall be well.
Linus,
Yes, senior.
my confusion is on the goodwill, the calculation of the goodwill.
The one that we have, let me see, where is that one? Let me show. This one.
Yes.
Okay. The question says both BOA and Henny were impairment tested at 30th November 2012. The recoverable amount of both cash generating units as stated in the individual financial statements at 30th November were 14.25 and 604 million respectively. The directors of Mini felt that any impairment of asset was due to the poor performance of the intangible asset, and it was deemed that other assets were already held at recoverable amount. The recoverable amount has been determined without consideration of liabilities which all relate to the financing of operation. So it means that the recoverable amount was determined together with the liability.
Okay.
So what we do is that we just take their total net asset from their financial statements. So the total net asset for BOA is 1130, because the question says that they were determined without taking into consideration the liability. So in actual sense, if it was taking the recoverable amount were determined, taking into consideration the liabilities, then what we have done is we have used the net asset that we use for the net asset table. It should have been that under the net asset table. So since they are determined based on the financial statement without taking into consideration the liability, it means that the liabilities are included in the recoverable amount. Or they have done that without subtracting the liability from the asset before getting that. So that was determined from only the asset.
Okay.
Okay. All right. So let's
the distance that purchase consideration 0.7 times. It seems that also confused me. I know of the total purchase consideration, then you less
this is for complex groups. Okay. But the explanation too I gave you are not there. Okay. You see that the mini is having 70% of BOA.
Yes.
Okay. And NCI is having what?
30%.
30%. Now, BOA is now acquiring what? 70% of Henny.
Henry, yes.
Okay. So 70%
no,
for
80%.
Is 80%. Okay. For what?
Yes.
For 320, isn't it?
Yes.
Okay. BOA is now the owner of what? Of Henny, isn't it? Okay. And BOA is owned by what? Mini and the NCI.
Okay.
So it means that the 80% over here is the owners of BOA that are acquiring the 80% for 320. So this 320 now, the owners will now be the parent 70%. NCI was 30%.
30%.
So the parent will pay 70% of this amount and NCI will pay what? 30%, because they are the owners. They are the one paying for the 80%. So the 320 will be shared among them.
Okay. So what about goodwill of BOA?
The goodwill of BOA will be for both the parent and then the NCI. That will be 70-30. I'm coming here. A minute.
Okay.
Sorry? Yeah. I will come right now. You go out. I will come right now. Before you go reach, I will come. All right. Okay. So this particular one, this assumption is always done for the subsidiary.
Okay.
Okay. But for the BOA now is the main subsidiary. So the parents will be having the 70% all right. The NCI will be having 30%.
30%.
Okay. But the question is, for anything that BOA will be having in Henny, it will be shared among the parents and then the NCI of what?
NCI.
Of BOA. Okay, so what we do is that whatever profit that will come, if the profit of the Henny is 30%, is 30 million, it means that BOA will be having 80% of this one.
80%.
But
Okay.
this 80% will be shared among the parents and then the NCI.
Okay.
So what we do is that, okay, whatever gain or reserve that will come from BOA, what will be the parent share? The parent will have 70% of 80% that BOA will be having from what? Henny. So for you to find
That's the indirect control.
that is the indirect control. That is how we determine the indirect control.
Okay. Okay.
So whatever that will come, the parent will have its percentage of whatever that the subsidiary will be having from that place. So if you take 80% over there, I will take 70% of it. So on average, what is the percentage that I'm taking from that particular person? It will be the 70%. That is how we determine the indirect control.
Okay.
All right.
Thank you.
Okay. But the complex groups is not likely. You might see disposal or cash flow, but anything can happen. So you can still see the same thing. Okay, let's try and see whether we can use the 35 minutes to say something about these footnotes here for question 2. All right. All right, so let's look at the first footnote. I don't know whether there's any issue here. Can someone take that for us, the first footnote, so that we can explain it?
The following information. Oh, sorry. Go ahead.
Continue. Continue, sir.
The following information is relevant to the liberation of the group statement comprehensive income. A. On 1st May 2008, Ashanti acquired 70% of equity interest in Bochem, or Motion, a public limited company. The purchase consideration comprised cash of 150 million, and the fair value of the identifiable net asset was 160 million at that date. Fair value of the non-controlling interest in Bochem was 54 million on 1st May 2008. Ashanti wishes to use the full goodwill method for all acquisitions. The share capital and the retained earnings of Bochem were 55 million and 85 million respectively, and other components of equity were 10 million at the date of acquisition. The excess of the fair value of the identifiable net asset at acquisition is due to an increase in the value of plant, which is depreciated on the straight line method and has a 5-year remaining life at the date of acquisition. Ashanti disposed of 10% equity interest to the non-controlling interest of Bochem on 30th April 2010 for a cash consideration of 34 million. The carrying value of the net asset of Bochem at 30th April was 210 million before any adjustment on consolidation. Goodwill has been impairment tested annually, and as at 30th April 2009, had reduced in value by 15%, and at 30th April 2010, had lost a further 5% of its original value before the sale of the equity interest to the NCI. The goodwill impairment should be allocated between group and NCI on the basis of equity shareholding.
Okay, let's take that first one. I don't know. The corporate reporting, most of the footnotes are actually loaded. The footnote will always be loaded. The footnote, one footnote will contain maybe information for solving one question. Okay. So let's now come. What is the reporting date now? What is the reporting date? It is 30th April. Okay.
30th April 2010.
Okay, so the acquisition was done on 1st May 2008. That was 2 years 2 years ago. So it means that if you are preparing the consolidated statement of profit or loss, you are going to consolidate what? The BOCHEM or the BOCHEM, which is the subsidiary, for a full year. So you add it to the revenue, 810 plus 235. You add all the two. Although they dispose 10%, but they will still be having what? 60%. They will still be having 60%. So we don't do anything. Even if they are losing control at the date of, at the reporting date, they still have control from the beginning to what? To the end. So for profit and loss, we still consolidate, but it's only statement of financial position that the assets will no longer be their own again. But for the statement of profit or loss, they are going to have a share of the full year profit because control was lost at the date of what reporting. So we are going to have a full year share of the profit. So profit or loss will consolidate because it is prepared for the year, not as at, it is for the year. So all those things that happen during the year will be reported there. Okay, let's come to this one. They have acquired 70%, and the purchase consideration comprised of what? Cash. So what we are going to do is like, let's calculate goodwill. We need goodwill to do whatever adjustment that we are going to do over here. So let's calculate the goodwill. Calculation of goodwill. Okay, let's calculate goodwill over there. So the goodwill, we have purchase consideration of what? What will be the purchase consideration?
150 million.
Okay, 150 million. NCI is what?
54.
54. Okay, so we are going to have 204. All right, let's come to how we determine the net assets. I will show you how we determine the net assets. We don't do it. Net assets are reporting and at acquisition for profit or loss. We only do acquisition to determine our profit, our goodwill rather. So we have the share capital. What is the share capital given to us? The question has given us the share capital and the return earnings at acquisition. That was 55. Can you see the 55?
Yeah, 55 and 85.
85.
And the return earnings is 95. Other component of equity is what?
Other component of equity is 10 million.
It's 10 million. Okay.
And it is 85.
85.
Retained earnings. Yes.
Okay. So you can see that we are going to have plans. The actual net asset should be 160. Am I correct?
Yes.
Okay. But let's add what they have in their books. 55 plus 85 plus 10. That will give us how much? Number 2. Question number 2. Okay. That will give us 150.
140. Oh.
Are you sure?
It's 150, oh.
Yes, 55 plus 85 is 140.
It's 150.
150. Okay. But they are saying that it's 160. And the difference is due to what?
Plant.
Okay. So the plant will come here as 10. Our goodwill will now be what? 44. Am I correct? Okay. But let's come now. We are going to have this plant from 1st May 2008. But the reporting date now, how many years is that? From acquisition to today, how many years is that?
2 years.
2 years. But the depreciation that we are going to charge on the plant will be for only this year because we are preparing the profit or loss for only this year. So since we are recognizing the plant, it means that we start using the plant from the date of acquisition. The plant, since we are recognizing the fair value adjustment, it means that the fair value adjustment is going to have effect from the date of acquisition, which is May 2008. So May 2008 to April 2009, that was 1 year, but we didn't prepare. That is not the financial statement that we are preparing. From 2009 May to 2010 April, that is an additional year. So you have to show the depreciation on the plant for this year. The plant is having the remaining useful life of what?
5 years.
5 years.
5 years. So it means that depreciation every year will be 10 over 5, isn't it? So that will be 2 million. So it means that every year we charge a depreciation of 2 million. So this year we are going to add the depreciation to cost of sales, the cost of sales. Okay. Mostly the question they ask you how they are going to treat the depreciation, you should add it to cost of sales. Because we are preparing statement of profit or loss, we show the depreciation for this year. But if it should be statement of financial position, it means that we have already used the asset for 2 years already. So we have to charge a depreciation of 4 million to retain earnings and now add 6 million to the PPE because it was 10 million at the date of acquisition, but we have used 2 years already. So the remaining amount will be what? 6 million. So the depreciation will be 4 million to retain earnings. But this one we are preparing statement of profit and loss. So we charge the depreciation for the year that you are preparing the what? The statement of profit or loss for. And that will be only 2 million. All right. Let's come. The carrying, okay, we have done that already. Ashanti disposed 10% of the equity interest to the non-controlling interest of Bochim on 30th April 2019 for cash consideration of 34. So that is what? The acquisition, we can't calculate again on it because we are not losing control. So this will be between the parent and then the NCI. And the question has already stated that is to the NCI. Good. So we have sold this for 34 million. The carrying value of the net asset of Bochim at 30th April 2010. So we are selling this at the reporting date. The current reporting date was 2010 million before any adjustment on consolidation. Goodwill has been impairment tested annually and as at 30th April 2009 has reduced in value by 15%. And at 30th April 2019 had lost a further 5% of its original value before the sale of the equity interest to the NCI. The goodwill impairment should be allocated between group and NCI on the basis of what? Equity shareholding. Okay, you can see that the question did not say that the company has recognized a gain of this and this on the sale, isn't it? The question does not specify that there was a gain recognized on what? On the disposal.
The 10%
yes.
sales.
Yeah, there was no gain on it. So you don't have to calculate anything and to reverse the gain. But this question can ask you to explain how the 10% what disposal will be accounted for. So they can ask A, explain how the 10% disposal will be accounted for. The question did not say that the company has recognized the gain on the 10% disposal to other income or anything. They didn't say anything like that. And if you look through this, you can't see any income relating to what? To the disposal. So don't assume that they have recognized a gain on it. Since the question didn't say it, just ignore it. But this particular footnote can be what? Can be used to ask a question that explain how the 10% what disposal should be accounted for. So we are going to assume how the 10% disposal will be accounted for. But before we do that, let's now look for the goodwill at reporting. The question says that the goodwill for the 2009 year, the goodwill has impaired by what? 15%, isn't it?
Yes, 15%.
So 1.15 times 44, what are we getting?
6.6.
Okay, 6.6. Okay. And the current year, the goodwill has impaired by what? 5% of the original value. So that would be 0.05 times 44. But I can say the goodwill has further impaired by what? 5%. So the 5% will be calculated on the net amount, which is 44 minus 6.6. But this one they say original value, so it's still the 44. But if they say the goodwill has further impaired by 5%, the 5% will be calculated on the what? The carry value at the beginning of this year, which will be the 44 minus the previous impairment, which is 6.6. But see, this one they say it is calculated on the what? on the original value. So 5% of the original value is what? I'm getting 2.2.
Yes.
Okay. So what will be the goodwill now? What will be the carrying value of the goodwill now? I'm getting 35.2.
35.2.
Okay.
Yes.
So that will be the carrying value of the goodwill now. Okay. Assuming the question asks you, so the goodwill, we are going to charge impairment of what? 2.2. This is for the current year. We are going to charge it to what? Administrative expenses. So you go there and add a goodwill of 2.2 to administrative expenses. Okay. Let's assume that the question is asking us how we can account for the what? The 10% disposal. Okay. If you want to account for the 10% disposal, this is how we are going to account for it. We first have to know the net asset at the date of disposal. Okay. They are saying that the net asset before any adjustment on consolidation is what? Net asset before any adjustment on consolidation is what?
210.
210. It means that this net asset, the plant's value is not part, because the adjustment for the plant will be done on consolidation. So we are going to recognize the plant when we are preparing the consolidated statement of profit or loss or financial position. So the plant is not part. And the plant currently is going to have what? A carrying value of what? Of only 6 million. Do you agree with that?
Yes.
We have 6 million. And goodwill was also not part of what? The net asset, because goodwill will be calculated on the date of consolidation. So the total net assets will now be 210 plus 6 plus 35.2. So what are we getting there? 210 plus 6 plus 35.2. I'm getting 251.
251.2.
So what will happen is that we look at the transfer that will be given to the NCI, and that will be 0.1 times the 251.2. So what will be the transfer? How much are we transferring to the NCI?
10%.
That will be 25.12.
Yeah.
Okay. But what is the cash consideration? How much are we receiving?
34.
34. So what will be the difference? We are transferring 25.12 and we are receiving 34.
Okay, 8.86. Okay.
That will be sent to other components of what? Equity. That will not be recognized as a gain, because we are not losing control. We only calculate a gain upon what? A loss of control. Okay. But if the question should say that the company recognize a gain of this one, the company recognize a gain on this one, the gain will be calculated on only the 210. Because the consolidation, the adjustment will be done at the date of consolidation. But this one, they have calculated a gain before the consolidation. So the gain will be calculated on this one. How will they calculate it? They are going to apply the 10% on this figure. So they have 21. Then they will subtract it from 34 and recognize a gain of 13. So we are going to subtract this gain from whatever they put it. Okay, but since the question didn't say, they can ask you, explain how the 10% disposal will be accounted for. We are done with the footnote 1. Let's come to the B.
Bochem acquired 80% of the equity interest in Serum, a public limited company, on May 1, 2008. The purchase consideration was cash of 136 million. Serum's identifiable net assets were fair valued at 150 million, and the NCI of Serum attributable to Ashanti had a fair value of 26 million at that date. On 1st November 2009, Bookem disposed of 50% of the equity in Serum for a consideration of 90 million. Serum's identifiable net assets were 160 million, and the fair value of NCI of Serum's attributable to Bookem was 35 million at the date of disposal. The remaining equity interest in Serum held by Bookem was fair valued at 45 million. After the disposal, Bookem can still exert significant influence. Goodwill had been impairment tested and no impairment had occurred. Serum's profits are deemed to accrue evenly over the year.
Okay, so you can see that we have acquired these people. The subsidiary has acquired the Serum on the same day that the parents acquired the subsidiary, isn't it?
Yes.
But on 30th November, which is in this current year, they have disposed 50% of the 80%. What is happening? They are going to lose control.
Yes.
Okay, they are going to lose control. So since they are going to lose control, it means that we can't consolidate these people fully for this year. So since they are going to lose control, we have to calculate again on the disposal too. But the question now is, what is the start of this current year? The beginning of this current year should be May 2009. Am I correct?
Yes.
Okay.
Yes.
So May 2009 to the date of disposal, which is 1st November 2009. How many months is that?
Six months.
6 months. So it means that from the beginning of the year, we have control over these people for 6 months. So we consolidate them for only 6 months. How do we do that? If you go to their revenue, you have 6/12 times 142. That is, we are going to have 6 months share of their profits. But the remaining 6 months, we are only going to have them as an associate because we are having 30%. That is giving us a significant influence. But we have control over them for 6 months. And the remaining 6 months, we have them as an associate. So we consolidate them for 6 months. And now what? Have a share of their profit. It's just like the disposal question that we solved the last time. But before we calculate the disposal, the gain on the disposal, we need what? The goodwill of the company. We need a goodwill. We need a goodwill. And you can see that this is also a complex group, isn't it? Which is a vertical one. Which is a vertical one. So what we do is that let's now calculate what? The goodwill. Let's calculate the goodwill. So goodwill for Serum will be calculated as, what is their consideration? How much did they pay?
536.
Okay. But the parent will pay how much of that? 0.7 times.
Okay.
Okay. The parent will pay 70% of that and the NCA will pay. So the goodwill, we are calculating it for only the parent. Okay.
Okay.
That will be 0.7 times 136. How much are we getting?
$95.2.
95.2. What is the value of the NCA at acquisition? Are we giving that?
26.
Okay, 26. Okay. Are we giving information on their retained earnings and those things, or we are giving information on only the net assets?
Only the net assets.
So we just pick them straightforward. So 95.2 plus 26. That will be 121.2. So the net asset is what?
115.
115. The difference is
6.2.
okay. So let's now come here. Okay. Let's now come. Okay. So what we do now is that since we are disposing 50%, it means that 50%, we are going to lose what? Control. There will be a loss of control. So we calculate a gain on what? Disposal. Let's calculate a gain on disposal. Gain on disposal. You can see that the questions, all the questions that I'm solving with you are tough questions.
Hmm.
Do you know why?
No, senior, unless you
Okay.
tell us.
No, you have to know. If you meet a teacher that is solving a complex question with you, it means that he cares about your health and he cares about your what? Your condition in the exam hall. So he's just preparing you that you have to do more so that if you go and meet the question in the exam hall, it will be very easy for you. But if they are giving you the easiest one and you think that you know, you get there, you don't know anything. So this one will tell you that, oh, I have a lot of things to learn, so I have to do more. Doing more, you are learning and you don't know. But some of them can also put fear in you. That the question is going to be very difficult. So let me I know that a lot of people are thinking whether they should write the corporate report. The thing is, if you don't write it now, when are you going to write it? Just go there, whatever. The answer that will come to your mind first, the first answer that will appear in your mind is the answer coming from God. All that one that will be coming from somewhere else. I don't know whether you have experienced that before. Especially if you are doing section A. The answer that you want to pick first is the correct answer, but something will be telling you that think through, and you go and pick the wrong one. So the answer that will come to your mind first, write it and move on. Don't think. It's always the right answer. Okay. Let's come. What is the amount what is the process that yes, senior?
Why are you taking 70% of 136? I thought you take 70 of 80 of 136.
No. The 136 is being paid by the what? The shareholders of what? It is the shareholders of what? Of
Bochem.
that are buying the 80%, isn't it?
Yes.
So they are paying the 136. But the shares of what? Bochem are divided like this. The parent is having 70% and the NCI is having 30%. So out of the 136, how much is the parent paying and how much is the NCI paying? It's only the gain that we do.
Linus, you know something, maybe some of us are also conversant with the one that you write the full distance and then you let the indirect holding of 30%. I think it will be the same. So maybe that's why it's confusing some of us.
Okay, so
but I think you arrive at the same answer.
Yeah, so do the one that you are comfortable with. Okay, so
this one is simple though.
Nick.
Yes.
The consideration will be paid by what? The shareholders of what? Of the subsidiary.
Bochem. Yeah.
And the shareholders over here, it is the parent and then the NCI. So if we are paying 36, I'm having 70%, you're having 30%. How will this thing be paid? I'll pay 70% of the amount, you pay 30%.
And you pay 30, yeah.
Okay, so that is the consideration that is how we are going to share the consideration. But if you count to the profits, the subsidiary will take 80% of the profit of what? Of the serum or I don't know. Okay, that 80% of the profit will be shared among the shareholders of what? Of the subsidiary.
Okay.
Yeah. And that will be 70 and 30.
Okay.
Okay. So the 80% over here, if you are doing 0.7 times 80, it means that you are finding only 80% of the 136. The 136 is paid for the full 186. The 136 is paid for the 80%. So the 80%, how will it be paid? I will pay 70, you pay 30. So we do that one if we are coming to the gain. If you are coming to the gain. But the consideration will be shared among them in their proportion. Okay. Let's come to the but we don't know how the reason why we have been doing 80 times the 70%. Okay. that was how we all just memorize it and say, if it is vertical, multiply the percentage. And We don't even know what we are doing. It is normal. Okay. It is normal. It is okay. It's not our fault. It depends on the person who taught us. Okay. That was how they were also taught. So life must still goes on. Okay. So what is the consideration that we are receiving? The consideration that we are receiving for the 50% is 90, isn't it? Is it 90? Who can dispose of 50% of, okay, for consideration of 90?
Yes, it's 90.
Okay. The NCA as at that date is what?
35.
35, okay. The return interest is what? The remaining equity interest of Serum held by
30%.
But they give you the fair value. So they'll always give you the value of the return interest.
45.
Okay, 45. Okay, then you total this. Then you now come. What is your net asset at the date of disposal? Would that be 160?
Yes, 160.
Okay. That 160 is excluding goodwill. Okay, so we add goodwill to it. Since we are losing control, we are not going to have a share of any of the, if we are having the company because of the location. Now we have disposed the company. It means that we dispose the location, all those things together with the company. So the goodwill will not be there again. So we take it off. So let's have this now. We have 166.2. Then we take it from this particular one. The summation of that will be one. Let me see. 90 plus
170.
Okay. So 170. The gain will be 3.8. So this gain, you show it as a line item, gain on disposal of a subsidiary, which will be 3.8.
But
this
P&L.
Yes, in the P&L. But this gain will be shared 70% will be for the parents and 30% will be for the NCI. But since we are preparing profit or loss, we just show a 3.8. Okay, someone can also decide to find a gain like this. Okay, you see that the total value of the net assets of the company at the date of disposal is 166.2. Can we see that?
Yes.
Yes.
But this one, it is the total value, but the NCI, we are not selling the NCI. So what is the NCI portion out of this? We take the 35 from this. So if you take the 35 from that, that is the portion relating to the parents. Minus 35. What are we getting? 131.2. Okay. So that is the portion relating to the parent. But the question is the parent selling all the 80%? No. They are retaining 30%. And the value of the one that they are not selling is 45%. So what is the portion? It's 45 million. So what is the portion that we are selling? We are selling only 86.2. And we are selling 86.2 for 90. So what is the gain? That is 3.8. Okay. So we decide to add these two to this one because these are already part of this. Okay. So we decide to add a 35, 45 to this one because they are part of this. So we can decide to subtract before we net. So any of them. All right. Let's look at, so that particular gain will be shown there. And that is all. We are done with that one. Let's come to, hey, the footnotes are plenty. Can we deal with the intragroup trading?
Atlantis has sold inventory to both Ochem and Serum in October 2000. The sale price of the inventory was 10 million and 5 million respectively. Ashanti sells goods at a gross profit margin of 20% to group companies and third parties. Here, and half of the inventory sold to Ochem remained unsold, but The entire inventory sold to Serum has been sold to third parties.
Okay.
That's all.
Okay. So you see, the where are we going to have the unrealized profit? Where? Whose inventory that we are going to have the
Ashanti.
unrealized? Okay, but the Ashanti has sold the goods to both
Yeah,
Pokem
so
and
it's
Serum.
Boken.
So whose inventory are we going to have the inventory on? The unrealized profit on. Some of them have sold all the goods to the third party. It means that all the goods have been sold. So we can recognize all
Yeah.
the profits. But some of them have half of the inventory sold to Pokem remain unsold. So it means that they have sold some part of the goods and some of them are left. At the time that the parent is giving the goods, the parent, you can't sell to yourself. The subsidiary is part of the parent and the parent cannot sell to the subsidiary. You can't sell to your branch. You are just transferring the goods from the headquarters to the branch. But since the two of you are keeping a separate financial statement or separate books, at the time that you are dispatching the goods to the branch, you are going to recognize it as a sale. And the branch will also recognize it as what? As purchases. But whatever happens, the sale of the branch will become the sale of the group. So if you are now adding the two figures, it means that you have to cancel your one that you have recognized as a sale. And the branch must also de-recognize the one that they have recognized as what? As purchases. Because you are not selling to me, I'm part of you. You are giving the goods to me. So you are not selling to me. Cancel the sale. And I also cancel the purchases to net the two. Because I have recognized the sale as purchases. And you have also recognized the sale as sale. So you remove that from the revenue. Okay, if you are removing that from revenue, what will happen is that one of them, this is financial reporting issue. Okay, let me just take it the way it should be so that it will not bring any big issue. Okay, so what we do is that you can see that all the goods for what? All the goods sold to Serum and what? All the goods sold to Serum were sold to third parties. So there won't be any issue of unrealized profit. But what will happen is that they are going to be having two revenues in the statement of profit or loss. They are going to be having revenue. So the parent will be having 5 million plus the 5 million of what? Of the subsidiary, which is the Serum, because the parent will recognize the 5 million as sale. And after the Serum has also sold the goods to the third party, they will also recognize what? A 5 million as sale. So you can see that one particular commodity is being recognized as is being sold at 10 cedi. In actual sense, the selling price is 5 million. So what we do is that we now bring it to 5 million. So what we do is we subtract 5 million from revenue, because we are going to add the two revenue. So we subtract the 5 million from the revenue. We subtract the 5 million from the revenue. We subtract the 5 million from the revenue. Okay. We subtract 5 million from revenue. Now, the goods were sold in what? October 2009. The goods were sold in October 2009. The goods were sold in October 2009. Very interesting. When was that particular subsidiary, the Serum, when was it sold?
November.
It is November, isn't it? Okay, that means it is, we sold the goods to them 1 month and we disposed them, isn't it?
Yes.
Okay, it means that the revenue that they have over there, which is 142, the 5 million is part, isn't it?
Yes.
Okay. So since the 5 million is part, they are selling the goods on our behalf. So before we prorata this particular 6/12 times 142, we have to take the goods that we sold to them, because they are selling the goods on our behalf. So they're supposed not to incur any what? They're supposed not to make any gain on that. So we subtract it, it will be 142 minus 5 before we charge the 6/12. So So the 6/12 will be charged on their actual revenue that they have made from their normal sales. The 5 million goods, they are selling it on our behalf. So it doesn't belong to them. We are going to have the revenue. We are going to enjoy the profit. So we take the 5 million from it before we charge it. We take the 5 million from it before we charge it. Okay. Then if you come to purchases, the subsidiary, the parent will be showing the cost of the 5 million. Since the subsidiary is supposed not to make any profit on the sale, the selling price is always the same as the cost price. So in their revenue, they are having 5 million. In their purchases, they are also having 5 million. So if you want to show the 6/12 times the cost of sales, you subtract the 5 million from it. So that will be 84 minus 5, because included in their cost of sales is the what? Cost of the goods that we have given to them to sell. They are not making a profit on the sale. So the selling price becomes what? The cost price. I've given goods to you to sell on my behalf. The selling price becomes the cost price for you. So you're not making any profit. So this is why this is the adjustment that you do before you calculate the 6/12. You take the parents' sales out of it, because that is not their revenue. They are selling the goods on behalf of the parents. They are selling the goods on behalf of the parents. So that 6 months, that particular cost and those things are not associated with their direct what? Operations. But if you come to booking, booking now has what? Half of the goods what? In inventory. So what we do is that we first remove the sale. So you go to revenue, you subtract the sales value of 10 million, you count the cost of sales and subtract the sales value of 10 million. What you have to do now is that you are subtracting the cost more than you should subtract it. Okay, let me just solve this footnote, then we stop. Let me show you something. In the revenue of the parent will be having 10 million at the time that they sold the goods, and the subsidiary has sold only half of the goods. So the subsidiary is going to show a revenue of 5 million. In the cost of sales of the parents, what will be the cost of the goods? The goods were sold at what? At a margin of what? 20%. So what will be? So what will be the cost of them? Would that be 8 million?
Yes.
Okay. So the parent will show a cost of what? 8 million. At the time that they dispatch the goods, they will assume that they have sold the goods and they are making a profit of 2 million on it. But if you come to the subsidiary will do something like this. They will have 10 million minus 5. Do you agree? They recognize the purchases of 10 million and they have sold 5 million of the goods. So the closing stock will still be fine. So they will have 10 minus 5, and that will give us 5, because they're supposed not to make a profit on the sale. They are selling their goods on behalf of the parents. So this is how they are going to show the cost of sales. And if you come here, the revenue will be 15 and the cost of sales will be 13. They are making a profit of what? 2. But the question is, you have given goods to me to sell for you. I haven't sold all the goods. It means that all the profit on the goods, you can't recognize it. I will only give the goods, the money for the goods I have sold to you, and retain the remaining goods to you. So the goods I'll be giving to you will now be measured at what? Cost price, not selling price. And that is why we find the unrealized profit and subtract it from the inventory. So the question now is, the subsidiary has sold only what? Only 5 million goods. So if the subsidiary has sold only 5 million goods, it means that the profit on the sale should have been only 1 million, because 10 million is 2 million. So if he sold only 5 million, it means the profit that the parents will be recognizing should be only 1 million. We are here to sell 5 million. So unrealized profit of 1 million is on that. So the question now is, the standard says that we should remove the sale. We should assume that there is no sale. So we should remove the sale. Okay. If we are removing the sale, then what we do is that we are going to have minus 10 over here and also minus 10 over here. Okay. So if you have minus 10 over here, it means that you are going to be left with what? The actual what? Sales, which is 5 million. All right. Or let me just put it like this. The revenue will be 10 plus 5. 10 plus 5. Then this will be 8 plus 10 minus what? 5. You can see that the revenue and the cost for the subsidiary has cancelled itself. The cost and revenue of the subsidiary has cancelled out. You can see that to be 5 against 5. That is 0, isn't it? The revenue will be this, cost of sales will be this. So you can see that the subsidiary own is 10 minus 5, which is 5. Revenue minus cost will give us 0. So you are left with only the parent portion, 10 minus 8. But the question now is all the goods were not sold. How many goods were sold? It should be 5 million. So it will be 10 minus 5 million. That will give us the goods that were sold. What is the cost of the goods that were sold? The cost will be 4 million. That will be minus 4. So this will be against 4. So 8 minus 4, 10 minus 5. So the profit will now be 1. This is how we should do it. But the standard says that we should cancel what? The sale. We should assume that no sales has happened. So if no sales has happened, you will now come here and subtract the sales value. You cancel the sale over here, cancel the sale over there, remaining only the sale of the subsidiary. Okay. And the standard also says that we should cancel the purchases because these people are going to recognize 10 million. These people are going to recognize 10 million. So 10 against 10 is 0. Okay, but you can see that this is now left with 8 minus 5. Can we see 8 minus 5 from this place? From the cost of sales. Can we see 8 minus 5?
Yes.
But the actual cost relating to the 5 million goods sold is what?
4 million.
Is 4 million. But 8 minus 5 is now what? 3.
Yes.
So how do we make it to be what? To be 4 million? We add the unrealized profit to it. We need to add the 1 million to it to now make it 4. So it means that we should have subtracted 4 over here. But we subtracted what? 5. Another way of looking at this one is that you can see that the goods were, the closing stock were valued at what? Net realizable value, which is higher than the cost. The cost is 4 million, the net realizable value is 5 million. But IS2 is saying that inventory should be measured at lower of cost and its net realizable value. So you are valuing the inventory at 5 million, which is the closing stock here. But we should have been what? 4 million. So
4
what
million.
we'll go and add the one back to reduce this one to 4 million. That is it. Or you saying that you are reducing it or you are adding the what? The unrealized profit to it. That is why we subtract the 10, the sales from this one, then we add the unrealized profit to it. Then we add the
To the
unrealized
cost
profit.
of sales.
Yes, to the cost of sales, to net that particular excess that we have over here.
Okay.
All right. So that is the idea about the unrealized profits. Okay. Seniors, I'm tired and I'm exhausted. So look at the remaining footnotes. They are very interesting.
So let's say if we were to prepare statement of financial position, we will send it to the net assets table, right? The 1 million.
No, it is the parent that is selling. So it will go to the retained earnings.
Oh, okay. Retained
It will
earnings.
go, yeah, it's the parent that is selling. So the parent is the one that is going to have the unrealized profit there.
The profit, okay.
Yeah.
All right. Thank you.
Okay.
Senior.
Yes, please.
Yes, it's always said that even if you don't understand some of the standard, you can still make some marks. But looking at the first question that we saw,
yeah,
see how the adjustments are many, it means the ticks are also many. If you are not able to understand to work out some of those things and just do the skeleton, I'm not sure that it can help you.
No, at least skeleton can give you like 5 marks. But you can still play with the net asset. You can still play with the net asset and still play with the goodwill. You can also still play with the NCI because the NCI, they'll always give you the figure.
Okay.
So you can put the NCI figures there. Even the group retained earnings, you can take the parent one from the statement of financial position and put it there. You can do some adjustment that is going to reduce that one or increase it. You don't have to adjust everything.
Okay, so as you go there, whatever you are putting, it doesn't necessarily mean that you should get the figure, the final figure and come, but they will still take whatever you are putting there, right?
Yes, yes. You can even prepare the listing without totaling. You see what the PP figure that I've placed here. You can decide not. You can do your listing without bringing these figures. Without bringing these figures, you can just stop here.
Okay.
Yeah. So it's not necessary for you to. The thing is, you are not even sure about whether you are adding or you are getting the correct one. So how will you? No. Why will you waste your time to add a figure that you are going to get 0 for? You see, but the figure that you are sure of, put them together. You see, the question that you know that your mark is there. If you go to the exam hall, look for the 15 marks first. Where the mark is, where you know that, okay, my 20 marks is here. Take your time. Do it nicely, but you have to make sure that you beat the time because it's 3 hours. So at least you can use like 46 minutes on that question. You know that, okay, I'm going to get 15 out of that. Then you go to the next one that will give you maybe 10 marks. You do it nicely. Then you go to other ones. And this one, if it should be exam, I will decide to add the figures and put the total there. Or I can decide to put the figures here and leave the total. But since we are learning, that is why I'm balancing it. You don't have to go and balance it exam.
Okay, thank you.
So the skeleton is very important because if you don't put the skeleton there, before you adjust one footnote, you don't even know where you are going to put the figures. But if you put the skeleton there, you know that, okay, with this one, let me go and add it to this one. So I'm done with that. I'll count to this one, step one by one. It is very important.
Okay.
Okay. Determine who the parent is. Then determine, you can scan the footnote. If you scan, the parent will always be the first company, and the subsidiary will always be the second one. Maybe the third one might be a subsidiary or an associate, but for corporate reporting, it will be a subsidiary because we don't have associate issues in corporate reporting like that. So just determine, scan the footnotes, know the parents, put their figures there, add the subsidiaries onto it. You can decide to add all of them. They will mark the ones that are correct because you don't know who the subsidiary, the third person, you don't know who the person is. So they will mark the ones that are correct. Then you come to your group structure. Make sure you put the group structure nicely. Post-acquisition date, those things nicely. You come to your net asset table. Corporate reporting, they will not bother you with how to determine your retained earnings. It's only financial reporting that you have to do some addition. You have to get the one at the beginning, add some post-acquisition profit to it before you get acquisition, retained earnings at acquisition. No. Corporate reporting, they will not bother you with those things. They will give you the retained earnings at acquisition, everything at acquisition, straightforward. So take it, put it there. Come to the statement of financial position. The figures that you are getting over there are the reporting figures. Put it there. If there's any adjustment you are not sure of it, you can take the acquisition figure and go and calculate goodwill. Just go and put a goodwill skeleton there. Put your consideration there, add the NCI, bring the net assets. So if you are sure, you can put the goodwill figure there and go. If there's any impairment, calculate it. Move on to the next one. Move on to the next one. You don't have to do all these things.
Okay.
You are not learning the corporate reporting to come and teach you. You are not learning to come and teach. You are learning to pass your exam, get your certificate, get
your certificate.
Get your promotion and start chopping money.
Okay.
So if you want to come and teach there, then that one there, after the exam, you can take your time and learn.
All right, thank you.
Yeah, but my advice would be, if you go, whatever will happen, I know that the capital reorganization question will come. That 5 theory math question will come. So do the question 4 first because you have the adjustment in your head. It's only the figures that are going to change for you. So since you have the adjustment already, you know whether the figure or this wedding, this is how I'm going to do it. So the figure, this is how I'm going to do it. You don't have to do anything. So that one you can even use 30 minutes to finish it. Then if you know that your interpretation, that is why your 15 marks is, take like 36 minutes or 40 minutes and do the interpretation. Then you come to the console and put a skeleton there. Your ethics, you can play around it and see whether you can get 6 marks there. Before even the 15 minutes, just draw your marks. Where you get your marks, put it on the paper before you. They will say start work. Then you move on. But don't fear. Don't open the paper and see the footnote. And if you panic, you are afraid of the paper.
This is true. This is true.
So don't fear. Don't. Even if you don't go to church, mention God's name, you do it.
Thank you.
Linus, please.
Yes.
Maybe if there is time, you solve one